Hi, and welcome to our workshop on bookkeeping setup for cooperatives. I'm Courtney Talbot, a consultant with Thrive Consultancy. We're an Arizona-based benefit corporation, and we've been working with the city of Phoenix the last few years to help jumpstart the cooperative economy in Arizona by providing technical assistance and support to values-based businesses such as worker co-ops. One of the big gaps we've noticed in the Arizona ecosystem is legal and accounting topics. So we really wanted to put together this webinar to help business owners in this space get prepared for success when it comes to bookkeeping and taxes. We've been lucky enough to have a wonderful CPA from Georgia helping us with this presentation, Audrey Griffin, and you will hear from her later in the presentation as she gets into some specifics on taxes. This presentation will be available for download on our website, so there's some links and things that you'll see in this presentation that you can download to then get access to those for future reference. Okay, why don't we go ahead and get started? So this is kind of our roadmap for the webinar today. We're going to talk about bank accounts, different accounting methods and what that means. We're going to look at some accounting softwares and compare and contrast a few. We'll look at your chart of accounts, what that means and what sections of that, what sections there are for those. We'll talk about some bookkeeping tips, both best practices for starting your books as well as ongoing items you need to think about. Then Audrey will take it away, talk about patronage specifically. That's something specific to worker co-ops and co-ops in general. And she's going to also discuss taxes. And then we have a list of really great resources for you to look at. Okay, let's talk first about a bank account. So you might think, well, we're going to just use some money from here, some money from there. You really need a separate business bank account when you're starting a new business. And when you're going to set up a new business bank account, you're going to want to make sure that you have access to monthly statements, that you can withdraw, transfer, and deposit money in all the various ways that you're going to be getting that money. So that could be cash, checks, or other services like PayPal, Venmo, or Cash App. Oftentimes, a good bank or good financial institution for a co-op is going to be a credit union. And you can go in and speak with them and talk to them about all your needs, and they can let you know exactly how their bank accounts work as far as online access and other things. You're going to want to make sure you keep all business-related expense receipts. This is really important. You want to be able to have backup for things that you purchased for the business. You want to keep copies of deposited checks. If you're doing mobile deposits, make sure you keep copies of all those checks with your other bookkeeping records. That's very important, as well as cash receipts for cash you're depositing at the bank. You want to make sure that you have proof of that if there was ever an issue. A few things to keep in mind. Really don't want to commingle personal and business funds if at all possible. It's really important to have the business by business items, especially if you have a business bank account that's for that purpose. If you absolutely must use your personal card or personal funds for business items, which sometimes happens, make sure you have a receipt and you can prove that the items were for business purposes and not just for yourself. What if you do have to do that once in a while, that's okay. You can have the business reimburse you. But make sure another coworker, employee, or bookkeeper, accountant, or someone is reviewing those records and signing off before you reimburse yourself. You want to make sure there's checks and balances so everyone's aware of what's going on when a transaction like that happens. All right, let's go to the next slide, please. So often when you're going to set up your books, your accounting software is going to say, well, what accounting method do you use? And so here are the differences between a cash basis and accrual basis in pretty simple terms. So a cash basis is really just when you record revenue and expenses when they're actually received or paid. So when income is recorded when that money is actually put into your bank account, okay? And expenses are recorded when that money actually comes out of your bank account. You can think of this like a check register in a way. Check register is only accounting for things when they're going in or out of that bank, okay? Accrual basis is a little different. Accrual basis records revenue and expenses when a transaction occurs, not when the actual payment is made or received. So let's look at that a little closer. For income will be recorded in accrual basis when you issue your customer an invoice or you've actually done that work. Invoices stay into an accounts receivable until they are paid by your customer. Expenses are recorded when you enter a bill from your vendor, meaning you've actually incurred that expense. The invoice will stay in accounts payable until they're paid. So a good indicator of which of these might be good for you is if you are having accounts receivable and accounts payable transactions, accrual basis is probably the best choice for you. Let's go to the next slide, please. Okay, so now that we've kind of talked a little bit about some basic accounting transactions, let's talk about the software. You really need to sit down and figure out all of the things that you need to track and what capabilities you need. Some software has too many capabilities that you as a small business may not need, but there's obviously certain things that you definitely must have in a software. So here's a good list of things to think about. This is not an exhaustive list, but this is a pretty common list. So first, what do you need to track? Basics would be, right, revenue and income and expenses. Those are going to be the most common things every business is going to want to track. Money coming in and money going out. Other things like payroll are going to need to be recorded. So your accounting software may have an additional add-on for payroll services. Maybe you're a business that needs to keep track of inventory. You're going to want to see if the accounting software you're looking at can handle those inventory capabilities that you're going to need. Sometimes point of sale systems have inventory. So you might want to say, okay, if I keep my inventory in my point of sale, how does that talk with my accounting software? And how does it need to talk to that software? You need to make sure that the equity accounts can do what you need to in the accounting software. For co-ops, those look a little different. Audrey will talk about that later. Potentially, maybe you need capabilities to track jobs and projects. Maybe you have a construction company and you need to be able to keep track of your progress billing. That's something you're going to want to see if your accounting software can do or not. Maybe you have departments that you need to keep different track of their expenses. Certain softwares have department level codes you can put into things to organize that information. If you're keeping track of your customers in your accounting software, you want to make sure that it can do what you want. Can it save their email addresses? Can it do anything else with that information? Or do you need a separate, maybe emailing system, customer relation manager system or something, right? Accounting software has come a long way, and some of them are really robust, and some just don't have these capabilities of things that you may need. And then another thing would be vendors and 1099 reporting. If you're paying a lot of vendors and you need to issue 1099s at the end of the year, maybe you want to consider getting accounting software that you could do that automatically with it. So again, these are just things to think about and see, are the options I'm looking at able to do what I need it to? And then some capabilities. If you have a lot of transactions in and out of your bank all the time, something that you might want to look for is accounting software that can automatically connect to your bank account and pull those transactions in for you, saving you a lot of data entry time. You're going to want to look at the financial reporting. Does it look like you'd like it to? Is it customizable? Is it going to suit your purposes? Budgeting. You can keep a budget in an Excel spreadsheet, but if your accounting software will do that for you, that's a great addition. So you can look at reports like a budget versus actuals report to see where you are along in your budget. Payroll is another one. Again, you could have a third party do payroll and import it into your accounting software, but maybe you'd rather have everything be all in one. So see if your accounting software has an option to add payroll capabilities. What about multi-user? How many people will be needing to get into your software? You need to make sure that the users that the accounting software is going to give you for whatever price level you're getting will be sufficient for your needs. Also, something to think about for that is, can your accountant connect to your bookkeeping software automatically? Or are you going to have to send them reports manually? That could be something you want to check. Training, education, and support is something people don't often think about, but you want to make sure, especially if you're not completely confident in your bookkeeping skills, that maybe your accounting software has a robust help center that could help you learn things you're not sure about. Maybe there's also chat support or call support. These are things you want to be at least mindful of when you're making a choice on accounting software. And then finally, connection to other applications. QuickBooks Online is the most probably well-known bookkeeping system, and it really in the last 3 to 5 years has become really robust in the other applications it connects to. Point of sale systems, things like online selling platforms. So if those are things you use other applications in your day-to-day business, you might want to see if your accounting software can connect with that and maybe bring some information in seamlessly that you will not have to manually enter into your accounting software. So again, before you make a decision and buy a software, really think about what do you need and what would be the accounting software that would best fit your needs. Let's go to the next slide, please. Okay, this is a breakdown of 5 common popular accounting softwares. There are websites on the far right for you to go check these out if you'd like. Some of them have free versions, others don't. We've listed some pros and cons here, as you can see, so I'm going to just look at a few of these. We're not going to go into each one. QuickBooks Online is, again, probably the most common and well-known accounting software, but I will say sometimes it just has too many capabilities for a startup, and sometimes you're paying for stuff you don't even need. That being said, it does have pretty good connections with other apps. It is widely known. It's probably a good chance your CPA will know about QuickBooks Online. You know, there's something to be said about that. And they also do have a mobile app which can really help with receipt capture and a few things that sometimes small businesses struggle with. Wave is a good option. It has a free version which can be really helpful for businesses that are really cost effective, worried about their costs. Then their pro plan is only $16 a month, which is not horrible in all actuality. As you can see, some of these other ones, Patriot, Zero, and FreshBooks, all are decently priced, especially when compared to QuickBooks Online. But please know, all of these companies, they offer discounts, they offer introductory prices, so the prices that are on here may or may not be what you might see when you go to sign up for these. But notice FreshBooks has a mobile app as well and some time tracking, right? That's important. But FreshBooks does not have a bank reconciliation feature in their basic plan. That's kind of a problem. So again, knowing where you might start looking is helpful. The prices are helpful. And then usually you can get a demo or a 7 days free or something with some of these, so you can see if you like how it feels. So again, I would suggest that if you're not sure, poke around on each of these websites, see what you think, come up with a list of all the things you need, and see which of these might be the best fit. Okay, with that, I believe we're going to switch it over to Audrey to talk about chart of accounts.
Thank you, Courtney. Hi, everyone. So your chart of accounts is just the big accounting word for the list of accounts that you're going to be using. So these are the accounts that are going to, that are going to control your that are going to tell you the balance of your cash, the balance of your revenues, your expenses, and things like that. So all of these accounts are going to appear on either your profit and loss or your balance sheet. And we'll talk about what those two things are in just a minute and how they're different. But the list of accounts is what's available inside your general ledger. And your general ledger, again, is just one of our accounting words for the shell of all the accounts and transactions that are occurring in your business. So your profit and loss statement is also called a P&L. It's also called an income statement. It's if you're a nonprofit or familiar with nonprofits, it can be called the statement of activities. But what I like to explain about the P&L or the profit and loss is that it tells the story. So it's going to tell a story of what happened over the period that you're reporting on. This is what came in, and these are the expenses we incurred. So these are the revenues over the 6 months or the year, and these are the expenses that happened. So some of your income accounts are going to be your revenues, like your sales or your interest income. If you have donations, that'll be a revenue account. If you have expense accounts, which most of us do, that's going to be your salaries, your personnel cost, your utilities, the cost of the things that you sold, if that's what you did, if you are selling items. So most of us are pretty familiar with that. Now, the balance sheet is another financial statement, and this one is a snapshot. It is not the long story. It's a picture of your organization at one point in time. So if we pull your balance sheet as of December 31st, it's going to be everything you have, which are your assets, everything you owe out to third parties, which are your liabilities, and then what's left over is the equity accounts. Now, one way that you can think about it is that everything you have is either because you bought it with what your owners have invested, or you bought it on credit, which is a liability. So everything you have is equal to and balances against the two things together, which are your liabilities and your equity. So your liabilities are going to be your accounts payable, which Courtney mentioned before. Now, these are just your day-to-day bills, right? A lot of businesses will take out loans or they'll have a line of credit. This is also a liability account. And then your equity accounts are going to be your owner share. So what your owners have invested in your co-op. It could be your retained earnings or your retained deficit, which is the history of your earnings or your losses. If you have patronage, if you have declared patronage in the past, then your retained portion of your patronage is also going to be an equity account. So, but your assets are really everything you have. So they're pretty straightforward. They're going to be what's in your bank account. If you have you've prepaid some funds for, say, your insurance or something, or your health insurance, you paid it for next month. That's an asset. That's a thing that you have that has value. If you have equipment, if you have a building, if you have land, all of those are things that you have. If you have a security deposit paid to your landlord, that is something that has value to you, and that's an asset. So all of these accounts are going to be that are in your general ledger, excuse me, in your chart of accounts are going to be either on your profit and loss or on your balance sheet. And so if you are using an accounting software, it's going to most of them are going to pull and are going to pull a profit and loss and a balance sheet. They have for you. That's what they're made to do, and so it won't be very hard to set that up. But if you're doing, if you're very small and you're tracking things in Excel, then you really need to understand how each account operates, like what its purpose is and where it goes on your profit or loss or on your balance sheet. So when you go into QuickBooks or any of these things, or any of these other accounting softwares, you don't have to worry about where those accounts go unless you create a new account. It has a default list of accounts that you can pick and choose from, and those will automatically be mapped to either the profit and loss or the balance sheet. So you don't have to worry about that. It's important to understand what the accounts are in the chart of accounts, because sometimes you're not sure if things are going to be expensed or where they're being recorded. Most people do look at their profit and loss fairly regularly, but they're not looking at their balance sheet as often. And because of that, sometimes we end up with some stray transactions over on the balance sheet that people meant to record to something on the profit and loss. So, if you want to just ever go, it's pretty easy to learn what kinds of accounts go on each of those. You can take a look at examples from other companies. You can do some quick searches on online, things like that. It's pretty straightforward if you're really interested in digging into that. And then I love this caution. I really want to point this out, to try and keep your chart of accounts reasonable, right? Not too lengthy. And I know you're going to ask yourself, like, what is too lengthy? My rule of thumb is that if you are saying that you have one expense that's going to hit that, don't create a new account for it, right? Because you're going to have one expense for everything. So if what you're doing is FedExing something, you want to have a shipping account, not a FedEx account, right? Because then you wouldn't put the UPS in the FedEx account, right? So create a shipping account. If you ship multiple times a year, you absolutely need an account for shipping cost. If you you ship a couple of times a year, but it's just not a big deal to you to track that, you probably don't need a shipping account. And then I like to tell people to answer what and not why. So one problem we see with people who get really creative with their chart of accounts is that they'll, instead of having a shipping account, they want to track the cost of a project. And so maybe they have to ship something as part of that project. So when you have an account that's, your project name, and then you have an expense like shipping, you don't know, or your bookkeeper's not going to know, does that shipping go in a shipping account or does it go in the project account, the project name account? And that's why I say answer what and not why you're making this purchase. And that is a good guideline for or whether or not you should create a new account in your chart of accounts. So the good news for co-ops is that I would say about 95% of your accounts are going to be exactly the same as another business. You're going to have cash, you're going to have liabilities, you're going to have revenues, you're going to have expenses, just like every other business. However, there are a few co-ops that are very specific to co-ops. And this is where we recommend an equity account for each owner's common shares. So when you have somebody who's interested in becoming a member, then they're going to pay a certain amount for a share of stock. Now, if you're a consumer co-op and you're going to have 5,000 members, you don't create a new account for each one. But if you're a worker co-op, you really do want to have, these are the owners of your company, and you need to be able to track what each owner has paid in, and for, for the history of the company. And so I find that that's best done in the software itself. It can be done on an Excel spreadsheet, but Excel spreadsheets get lost, right? So I thoroughly advocate doing it in the software itself. So this would be each owner's initial investments, the one that they had to make to become part of your co-op. And then this would all subtotal to the total number of common shares you have. So if you have 50 people who gave $1,000 each, then you would have 50 accounts, and it's going to total to $50,000. Doesn't that sound nice? So once patronage occurs, and we'll talk about what patronage is in a couple of slides, but once patronage occurs, you're going to need an additional equity account for each of the owners that's called retained patronage. And retained patronage is the portion of the patronage that you didn't pay out in cash. Again, we'll get into the details of that, but that's going to be listed by each owner, and sometimes even by each owner by year, but definitely by each owner. You need to be able to see what you have retained on behalf of that owner in each of the years that you return profits to your members. And so those are both in your equity section. Now, your patronage payable will be there for a short period of time. So it's in a current liability because you have to pay it out. And that is the portion of the patronage that's going to be paid back out to your members. And it's not going to be there all year. It's only going to be there from the time your board declares patronage to the time you pay it out, and then it goes away. But it is a liability because you owe it to people who are not the co-op. They're the owners of the co-op, but they're not the co-op itself. So that is a current liability. Next slide. Okay, so bookkeeping items then, how to handle new transactions and old records. So when a co-op is formed, a lot of times you'll have one or two people who are the owners of the co-op and the original members, and they have a lot of the old records, right? They have a lot of startup expenses. There's a lot of things that go into the business before you can open for your first day of business. So we encourage you to always keep all your receipts. Enter those into your bookkeeping system as an expense provided by the owner. So that would be kind of the owner's investment. Or you can enter it kind of as a loan. So it's a reimbursement that's going to be paid back to that owner. And however you want to do it, it's fine. You can either show it as owner equity or as a loan paid back to the owner, but you really want to make sure you track those. A lot of those softwares have the ability for you to attach a PDF or attach a document to a transaction. So if you have accounting software, I think that's a great way to hold it in there. If you don't, you want to make sure you have the paper and then having things scanned so that other people, you're storing them somewhere like in a Dropbox file or a Google Drive or something like that, is always a low cost alternative as well. And you're going to choose a start date for your books. This is kind of it's the day, it's going to be a day that you open your doors and you start making sales and revenues. That's usually when a lot of activity starts. Um, you can you can start it before that. Like if you want to get up and get ready and get running and have your accounting software, then you may have just some equity in there, but maybe not a lot of revenue. So, but you do want to decide on whatever date you're starting and then make sure you're tracking everything in your system as of that date. And then you need to decide when you're creating your co-op if you're going to follow a calendar year or a fiscal year. And a fiscal year is just a 12-month period that you end at a time other than the calendar year. So this is companies that have March 31st year ends, June 30th year ends, September 31st. Sometimes they end in July, things like that. So people always ask me which is better. And the truth is, it really depends on your business, right? When does your business cycle? Do you have seasons? If you have seasons, then a lot of times people end it after the last the biggest or strongest quarter. Sometimes they end it like if you work in education, a lot of times you follow the school year, right? So there are things that might make sense for your industry. If not, then a fiscal year is as good as any other time. I mean, excuse me, a calendar year is as good as any other time of year. There's not one huge advantage. It's really whatever makes sense to you and your business model. Next slide. So, okay. And next, how to decide, oh, excuse me, deciding how to keep the records moving forward, always important. I would say that when you're working with other people in a cooperative situation, don't assume, right? Don't assume that another person is going to do it the way it needs to be done. Decide together, cooperatively as you will, and create a system. And as a best practice, you can document that system, right? Document what's supposed to be happening. Because when you work with co-ops, you're working with a lot of other people. And so you want to make sure that everybody understands how they can access a receipt, how they can look at find something. You don't want a big stack of paper at one person's house, right? So, because that will quickly get gone. And then 5 years down the road, you're not going to be able to find things. So digital is best at this point. And then you want to make sure you all decide together how receipts and expenses and all of the documentation is going to be tracked. Are you going to keep them paper? Are you going to keep them electronically? How are you going to do it? Are you going to upload them into your accounting system? Are you going to put them in Dropbox? Pick one system and stick with it. So, how are your employees or your worker owners going to submit the financial information to the bookkeeper or the accountant? Right. So when they have an invoice that comes in, when they're out and they spend money on behalf of the co-op, how are they going to give that information to the bookkeeper or accountant? Some of the softwares on the list do have a mobile app where you can just take a little picture and shoots it right into your software. That's great if that's what works for you. I've seen other co-ops that will take a picture and email that picture to a specific email address that the bookkeeper or accountant has access to. If you have a physical location and everybody's together, you may have just an inbox, right? Like just literally a box on the accountant's desk. Everything goes into here. So decide what's going to work for you and then create that system and stick with it. The next question is, how does your POS connect with your accounting software? And I just want to define what a POS is real quick. That is a point of sale system. So that is how, if you're in a grocery store, then that is the cash register. If you are selling at a farmer's market, that may be your little Apple swipe thing you do, a square thing, right? So that is where the sale occurs, your point of sale system. And it can look different ways for different industries. So how are you collecting money? How are you ringing people up, per se? And then how does that information get into your accounting software? So it may be that you enter that manually. And by manually, I mean by an invoice in QuickBooks that agrees to the deposit. It may be that that is transferred over. You want to understand that process really well. A lot of POS systems will connect with your accounting software. That can be a dream or a mess. So just make sure that you understand how that's happening and that you are clear that that is the correct information is being sent over. It's being mapped into your accounting software correctly, which means it's hitting the proper accounts. So don't just hook it up and hope for the best, because that never works out. That's why a lot of people do enter information manually. So if you don't have that many transactions, it might be just as easy to enter that manually, especially if you have your bank account linked in, right? That can speed up that process. Sometimes it's done daily, sometimes it's done weekly, sometimes it's done monthly. All of those things are okay as long as they work for you, the users of the financial information. If it's being done monthly, but you really need to have weekly numbers, then monthly doesn't work and you'll want to speed up that process a little bit. Now, number 4 is payroll and how it's being processed. So, there's lots of great third-party payroll providers. Some of them have sites where you can log on. Some of them have an app. Sometimes you need a good old-fashioned time card where you just fill it out by hand. Sometimes people keep an Excel spreadsheet that's approved by their supervisor. There are a lot of different ways you can do that. Again, there's not one that's best. It's really whatever works for you and how complex your organization is. So then once you decide how your payroll is going to be, the information is going to be gathered by time cards or to clock in, clock out, however that's going to happen, then you're going to have to find out how the payroll entry is going to be entered into the accounting software. So, if you're in QuickBooks, or I think Xero has a payroll option as well, then it will all be processed and entered in there. So you just enter the time in. But the payroll processing itself happens in the software. If you work with an outside provider like Paylocity or Gusto or ADP, a lot of those will create an entry that you can bring into your software. Some of them will work where it maps directly into your software. So either any of those systems can be great. When you automatically connect things, I just really encourage you to make sure that those entries are accurate, to make sure they're set up properly, so you don't end up just pulling your hair out later trying to figure out what the automatic entries are. Next slide. So common mistakes. Things that people wish they knew, right? Before they get too far down the road. One of those I'll say, and I am, probably a little biased, is don't wait to find your accountant. So your first tax return is, technically due as soon as you are incorporated and start receiving money, but definitely due by the time you're taking some sales and you have some activity. You don't want to start looking for an accountant then, especially because you're a co-op. There aren't that many co-ops, uh, and so there's a lot of accountants aren't familiar with a co-op. And we'll talk about later some ways that we get some resources you could give your accountant. If you have an accountant that you love working with and you have a great relationship with, then by all means, I encourage you just to ask your accountant to see if they can take the time to get familiar with co-op returns, right? There are some great resources out there, and I'm always happy to bring more people into the fold of cooperative accounting. So, but begin looking for an accountant early. So if you know you're going to find a co-op, join a co-op then, or form a co-op, that just as soon as you decide on that organization, then that is a great time to start looking. Don't wait until 2 days before the tax deadline, because no accountant is going to be able to take you on at that point. They're going to need some information, even just to file the extension for you. So start looking early and make sure that your accountant is familiar with co-ops or has time to get familiar with them. Avoiding delays. Waiting until the last minute can often mean missing your deadline. You are not the only client your accountant has, and everybody waits until the day before the deadline, right? So a lot of accountants will say, if you give it to us within 2 weeks before the deadline, we are going to extend the return. 2 weeks is not sufficient time to prepare. Even though you think that you did great getting it into your accountant still needs time to look through the information you've given, have time to work with you, ask questions to clarify things. They're going to then prepare a draft of the return and give it to you to look at, and then you're going to want to have time to look at that. So 2 days, 3 days before the deadline, not a good idea, right? So that's why we say start this process early. Your accountant, if you're established under their system, will probably send out an email to you well in advance going, these are the things I want. Let's go ahead and start working on gathering those. So the next one is common mistake is not maintaining detailed records. So you want to track all the cash received and you want to categorize it. 2 years later, nobody knows why you got that $500 in. So nobody knows. So another thing that happens with co-ops is people cycle on and off boards. So the treasurer at the time may not be the treasurer later, right? So people switch positions. So they may have been the treasurer before, but the person who's actually preparing the tax return next year may not have been involved in the co-op when these transactions occurred. So make sure you track everything in a very detailed way. You show why you received it. Is this a sale? Is this a donation? Or is this an equity purchase? Right? So just to note that donations are going to be taxable to your co-op. People might donate. You might receive a grant. Those things are very likely taxable. The only thing that is definitely not taxable is an equity purchase, but you need to make sure that's recorded appropriately, recorded correctly. So it's not recorded as a revenue so that your accountant knows that is a non-taxable transaction. So you also want to record all the transfers in from PayPal or Venmo or Cash App or whatever electronic platform you use, with the same level of detail. So a lot of times what I'll see is I go to do the first year tax return and there is a PayPal transfer and they just call it PayPal sales. And I'm like, but what is it? And they're like, it's the money from PayPal. And I'm like, that's awesome, but that tells me how and not what. So we need to know, were those transactions in PayPal? Were they equity transactions? Were they sales? Were they donations? What were they, right? So that same level of detail applies no matter what platform or method you received it. Um, and number three is a big one. So I'll tell you my scary story is I had a client who was a co-op. They were a startup and they got a great grant. They got $100,000 to be given to them over 3 different years. And you know when they got that first transfer of $100,000? That first transfer was in December. So they didn't have time to spend that grant. So you know what we had to do? We were going to either have to pay taxes on it or give it back. And so with them, we worked it out, but don't make that mistake. Grants are taxable income unless you spend them. And in that case, they're still taxable income, but now you have expenses that offset that grant money, right? So the grant came in and all the expenses add up under them, and your total at the bottom is zero. You spent that grant money, so there's no tax of that. But grant money is always taxable unless it's specifically written, and most of it is not written to be non-taxable. So be very aware of that. Don't take a big grant at the end of the year because you won't have time to spend it before the beginning of the year. I mean, before your year ends. A mitigation tip. This is what we did with my client that was kind of in a nightmare situation for a minute. We used a fiscal agent. So the fiscal agent is a nonprofit. They don't pay taxes. They receive the grant on your behalf, and then they send it to you as you spend it. So in this case, the grant was being sent to them quarterly so that they would spend the money, or they would say, we know we're going to spend X amount this quarter, and then that amount of the grant money would come over. So once it came into their accounting, into their hands, then it was taxable to them, but they had the expenses to offset it. So be very careful with that. Having a fiscal agent is a great partner to have since you are a taxable entity as a co-op. So, and know when to file your tax returns. I can't tell you how many clients I've worked with that I have 5 and 6 and 10 years worth of tax returns to file. They just didn't know, so they just didn't do anything, right? Not a great plan. So technically it's as soon as you incorporate, even if your return is showing all zeros. But you really, really want to make sure that if you have, taxable transactions like selling goods and services, absolutely make sure. If you have an employee, you better be filing a tax return because they're going to come looking for you. They can cross-check between your employment, your reporting for employment, and whether or not you have an income tax return. So you definitely want to do that. The good news, I will tell you right now, is that if you're not making money, the IRS does not have, the IRS has a late payment penalty, but not a late filing penalty. So the IRS will, if you're not making money, if you're making money, whole different ballgame. If you're not making money, which a lot of startups do not make money the first few years, then you will not be penalized by the IRS for late filing, only for late payment. But they are serious about the penalties. So if you are concerned, go ahead and raise the questions with your accountants. Make sure you know what you're doing because nobody wants to get caught in that. States will have late filing and late payment penalties, so you're going to have to pay more. Every state is different, and I don't want to speak to Arizona right now in case this is out with other non-Arizonians. But to ask the question. If you're not sure and you're on the board, ask the questions. Okay, next slide. Oh, okay. We can talk about something more cheerful, which is what you do with your profits and not mistakes you wish you had made, right? So this is one of my most fun topics to talk about because patronage is is a preferred tax savings tool. It's a preferred, this is kind of what makes you a cooperative in the sense of how this is what makes you different from other businesses. So other businesses return their profits to their owners based on how many shares they own. You owe 60%, you're going to get 60% of the profits. But in a co-op, it's radically different in that you return profits based on the amount of work you have or business you have done with the co-op. So in a worker co-op, that's usually based on hours worked, right? So how many hours did you work for the co-op versus somebody else? If somebody else worked twice as much as you, then they're going to get a return of profits that's twice as big as yours is, right? And that's fair because that's how much they've worked. So the patronage is the return of profits to the owners. It's based on hours or how you do business if you're in a different kind of how you do business, which is that term patronize, right? How you patronize the co-op. So if the co-op returns the profits at a flat rate, so they just go, oh, $20 for everybody, or they say they come up with some other really creative ways to return profits, it may not qualify as patronage in the eyes of the IRS. So the IRS has some very specific rules, and they have very specific rules because they want to make sure you're doing actually that. You exist to serve the needs of your members, and you're returning the profits back to your members. And they give you a really great tax advantage for doing that. So, so they're not just kind of letting this be a loosey-goosey kind of idea. There's some very specific rules about it. To qualify as patronage is really to be qualifying patronage is really important to make sure you get that tax deduction. So the tax deduction is going to be on this year's tax return, but the patronage may not actually go out until up to 9 months later. So that's one of the advantages of being a cooperative, is that to declare patronage, you have to get to the end of the year. So we get to the end of our year, and then we say, yay, we made a profit, and we want to return that back to our members. Well, it's going to take, you're now into the next year, right? Like, so if you made a profit in 2024, that patronage decision and those results aren't going to be known until well into 2025. So that most of the IRS rules require you to pay the expense. If you want to deduct it on your 2024 return, you got to pay it in 2024 or just right after that. This you can actually pay out a little bit later, but not more than 9 months. And then the other really big advantage that you get is that you only have to pay out 20% of that patronage. So if you have a patronage dividend of $100, you can pay out up to $100 and take the $100 deduction on your tax return, but you could pay out as little as $20 and still take the $100 deduction on your tax return. So to my knowledge, this is the only time in the tax code that the IRS is going to let you take a deduction for $1 and only pay 20% of it out. So that is one of the very big advantages of being a co-op. It's really great for your co-op to be able to take those deductions to reduce their taxable income, sometimes all the way down to zero, and pay no taxes, but only have to pay out a minimum of 20% of that. Now you can pay more. And for worker co-ops, I'll encourage people to pay more than 20% sometimes. And you'll see why on the slides coming up. But the minimum is 20%. And that really helps co-ops grow and invest in themselves. This does not apply to a cooperative partnership. This is only available to a C Corp, to a cooperative organized as a C Corp. If you're organizing under the Arizona new law, then you're organized as a C Corp. So you would be, this would work for you. But I will say that don't try to go this on your own. Make sure you're involving your accountant in this process so that you can make sure that all your I's are dotted and your T's are crossed.
And Audrey, I want to point out one more thing. In Arizona, you must have 5 worker owners to be a co-op. So obviously all 5, you would have to have that for this to qualify as well.
Yes, yes. All right, Hannah, next slide. Okay. So this patronage is a little hard to imagine. And so I like to work people through a really simple example. And in this example, we did only have 3 employee owners. So I just made that change so that we didn't have a lot of numbers on our screen, but do keep that part in mind that under Arizona law, you do have to have that 5 owner minimum. And I will say that that is a fantastic best practice when you start being a co-op too, to have more than 3 employee owners, right? Because nobody ever said starting a business was easy. And so it just doesn't work out sometimes. So having more owners means your co-op will be stronger. So here's the scenario. We're calling this our happy worker co-op, right? And this is our first year of being in business. And in this first year of business, everybody was really happy and we earned $20,000 in net income in that first year. It was a great year. So we have 3 employee owners, but we have 5 total employees, right? So we have 2 employee owners who are not, I mean, excuse me, we have 2 employees who are not owners. They're just regular employees. Maybe they're going to be owners later, maybe not. Another important thing that your discussion you'll want to have is that you're going to need to define what is full-time, what is part-time. Does full-time, is that going to be 35 hours a week? Is that going to be 40 hours a week? It's really important that you define that. Because you're going to have people working at different amounts. And so you want to make sure that everybody understands how much they need to work to be considered full-time, right? And then there's even other questions like, does vacation count? Does maternity or paternity leave count toward those hours? So these are questions that you're going to want to really think through before you get to that situation with your owners. You want to think about those and talk about those and define them in your policies and procedures. Um, but in this situation, we had 3 employee owners, 2 non-owners. Of our 3 employee owners, 2 of them work full-time. So that's Claire and Sam. And then one of them worked half-time. All right. So then we have our 2 employee non-owners who both work part-time. So the first step that we have is that we have to determine how much of that $20,000 is actually going to be available for your patronage. And some people are surprised to learn that if you have non-owners working in a worker co-op, that a portion of your profits is not eligible to be returned. So it's only the portion of the profits that you can return that are due to the work of the owners. So how do we figure that out? Well, the first thing we do is we list every owner and every employee, and then we list how many hours they worked. So those added up to 7,280 hours. So those 7,280 hours were the hours required to earn that $20,000 net profit that we have this year. Okay. So it took not just the owners, not just the non-owners, but everybody working together. So then the question is just below that, how many hours are due to the members? So that 5,200 then is the total hours for Claire, Sam, and Tia. And that left 2,080 hours that were just from the non-owners, right? So the members' hour percentage of the total is 71%. So 71% of the 20,000 is how much that's available for patronage. We call that your patronage pool, right? So the amount, what is that, 29% that's left over, you're going to pay taxes on that. Right? There's no real way around that. You're just going to have to pay taxes. So, so the more people you have as worker owners in your co-op, the stronger you are, the fewer, the less taxes you can potentially have to pay, right? So now that we know that 71% of $20,000 is 14,200, then we have a second step, which is going to be allocating that patronage to the members that worked. How much are they going to get each, right? So here we do it again on the basis of the work that they did for the co-op. So on the number of hours. Claire and Sam each worked 2,080 hours. Tia worked 1,040 hours. So all we're doing there in the next column is determining what percentage of the total hours that is. So 2,080 is 40% of the 5,200 total hours that the employees worked this time. And then we're applying that percentage to the total of 14,200. So 14,200 times 40% is 5,680. And we use those percentages and allocate out the entire 14,200 to each of 3 owners. So we are returning the entire 14,200 that's available back to the owners. Now, they're not going to get it all in cash. You have that option. But in this situation, this co-op is going to only pay out the minimum portion that they need to, and they're going to hold the rest of that back at the co-op. They're going to hold that cash in. So the IRS requires that you pay out a minimum of 20%. You can go as high as 100%. That is also allowable. But if you go down to 15% of payout, it no longer qualifies for the tax deduction. So you definitely don't want to do that. With worker co-ops, we usually see payouts that are higher than 20%. And the reason is because Claire is going to show income on her investment, so income from the co-op, of the full $5,680. And that's very important that your employee owners understand, is they're actually going to get what's called a 1099 PATR that shows $5,680. Now, in this situation, in this scenario, Claire got a check for $1,136. And then now she has an increased investment at the co-op called retained patronage. It's in the equity section, as we spoke about before, on your balance sheet. So below her common shares is her retained patronage, and that's going to be $4,544. But what she really got is the full $5,680 because she has a bigger asset, a bigger investment in the co-op now, plus she got the cash. And that is the same process for each of the employee owners. So Sam got the same thing. Sam worked the same amount that Tia did, has the 40% allocation, and then got $5,680 in patronage declared back to them. They got a check for $1,136, and there's 80%. They have retained patronage of $4,544. Now Tia didn't work as much, so it just makes sense that Tia's not going to get as much. Tia's going to get half what they got because she worked half the time that they did. Tia's full patronage dividend is $2,840. So, but the portion she gets paid is $568. And then her 80% retained portion is $2,272. Now, I will point out, I've had this ask a question. When you declare patronage, you have to pay out the same, right? Your percentage needs to be the same. You can't pay out 20% for somebody and 40% for somebody else. It needs to be 20%. This year, the board decided we're going to pay out 20% and retain 80%. Or this year, the board decided we're going to pay out 60%, retain 40%. However you want to do that, depending on the cash needs of your owners and of the co-op, you as the board can decide, you as the co-op decides, but it needs to be the same for everybody. Okay, so moving down then, that 14,200 is your tax deduction. So you had a $20,000 net income. You you declared $14,200 in your qualified patronage dividend. So that leaves you with 5,800, and that represents the portion of the profit that was due to the non-members working back from our step one. So that $5,800 is going to be taxed. That is taxed, and you're going to pay income taxes at the corporate level, at the co-op's level on that amount. So you can see that there's a couple of different steps here. There's some rules that you really need to follow. There's also some rules about when this can be done, what the time frame is, how long you have to let your owners cash the check. There's some rules and some best practices around what happens if they're just like, oh, we don't want to cash the check. We just want you to take it all. like, which are well intended, but kind of mess up our tax rules. So, you really need to know what you're doing. And this is just a situation where I say, make sure you work with your accountant on this so that you qualify for the tax deduction. All right. So on the balance sheet, yep, Hannah, we can go over there. So this is what your balance sheet looks like. Remember, this is the snapshot after the first year. So in your equity section, you're going to have the regular owner shares. You're going to have your regular owner shares. So in this case, they each paid in $500. And now you're going to have these retained patronage amounts. So your equity section just got bigger. Your retained earnings are just below that, and that is what's left over after you pay your taxes. So that's $20,000 minus that was the $20,000 net income minus your $14,200 that you had in patronage, and then we had the expense left, the tax expense, which is 1,218. So that all comes out to $4,582, and that's what's left in your retained earnings. So that's pretty good after a first year. Yeah. And you'll also see in your liabilities, if you look at line 17, you have a patronage payable amount. So that represents the 20% that's due to your employee owners. So that's that. So I hope that helped clarify. I know that's a lot of numbers, right? But I hope that helped clarify a little bit. So you can just kind of see what that process is and what patronage really means. But I don't expect anyone to just go, yay, we get it now. It's okay to still feel fuzzy. That's what the accountants are for, right? We can help walk you through those. Okay. So there are lots of taxes, right? We all know that. There are lots of taxes. You're going to be taxed at lots of levels. And I just like to kind of point out to people at some of the taxes. My disclaimer is you may have more taxes, right? I may not know about some taxes in your area, but these are the big ones, right? These are the big ones. Income taxes. Everybody understands we pay income taxes just like you do for your personal, yourself, as an individual. You're going to pay income taxes at the co-op level to the federal agency and the state agency. So the federal agency is the IRS, your state agency is your Department of Revenue. So you're going to file income tax returns, and those are called the 1120C. So that's the 1120 for co-ops. And the AZ 120. So Arizona doesn't have a form just for cooperatives like the IRS does, but you file yours on the Arizona Form 120. And so you're going to file income taxes at the federal and the state level. Sales taxes. Now, sales taxes are at the state and local level. So you'll have sales taxes that are assessed at your state level, and and then you'll have sales and use taxes, I should say. So those are at the state level, and some municipalities also assess a sales tax or a use tax at the local level. So your job, if you are selling things to the end user, you have to collect those sales taxes and remit them, right? Just a word, if you don't collect them, you're still responsible for them. So you really want to know what the sales tax rules are on the items you sell them. What I mean by that is just because you didn't collect them from the customer, if your state does a sales tax audit, you will still be responsible for them. So they come out of your pocket. So you want to make sure you're clear on that. Property taxes are usually assessed at the county level. So these can be real property, which is like land, or personal property, which is movable things, right? So those are usually assessed at the county level. In my experience, they're due sometime in the spring. If you own real property, you are going to get an assessment. If you own for personal property, it really depends on the county how that works out. I've seen lots of different variations of that. Payroll taxes. Everybody knows that we have payroll taxes, but some people aren't real clear that payroll taxes and income taxes are very different things. So payroll taxes are taxes that are going to be due to the federal and state governments, and they are due at the same time you process your payroll. So as soon as is administratively feasible, when you process your payroll, you need to remit those funds over. Payroll taxes can get you in big trouble. They can get you some really high penalties. So you want to make sure that you're using, that you have a good payroll system, right? That you're either using a third party provider, or that if you're doing it in-house, that you're really making sure that you've, dotted your I's and crossed your T's, because payroll penalties are not pretty. Now, 1099s are your reporting obligation, but not your tax obligation. So let me say that again. They're your reporting obligation. If you pay someone as a non-employee, so you're paying them as a, you pay your plumber, you pay the person who cuts your grass. I don't know, you don't have a lot of grass in Arizona, but to move your sand around, right? Like whatever you pay somebody for, your landscaping, right? Then that person may need a 1099. My recommendation is to ask all of your vendors to give you a completed W-9, which is the form they give to you, so you know if you are required to issue a 1099. Ask for that before you give them the check, because once you've given them a check, they may not ever give you a 1099, right? I mean, excuse me, they may not ever give you the W-9, and then you don't know if you need to issue a 1099. So, because you want to do the right thing, the best practice is always to ask them for that W-9 and do not release the check until they give it to you. So that's not legal advice. That's my best practice advice, because people will disappear on you around the end of the year, because you know why? They don't want to pay taxes on it. And if you issue a 1099, then you are reporting to the IRS and to the state that you paid them that money. So if they're trying to be shady, you don't want to be part of their shadiness, right? So make sure you get that information in, and always, 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 the best time to get the information is before you cut the check. So you also need to register at, let me speak on just one more thing on 1099s. So 1099s, the NEC is called the non-employee compensation. So that's when you pay basically contractors to do work. So they're not employees, but you're paying them over $600. Miscellaneous has its own set of rules. That's over $600. The PATR is the one that you would only issue. It's a 1099 PATR. You only issue it if you pay patronage that year, right? So that is when, and if you pay over $10 in patronage, then you need to issue it. So make sure you understand what the rules are. Make sure you understand who qualifies. There's a lot of great resources on the IRS website about that, or any tax accountant will be able to answer that, not just a co-op accountant. This is something that's applicable to all businesses. Don't get in trouble for not registering at your state, right? That can be really not pretty sometimes. States frequently have a minimum franchise tax. So even if you don't make money, you still got to pay a tax for the privilege of doing business in that state. So you want to make sure you're registered, you're incorporated, you're registered, you're current, and that you are filing all the appropriate returns. If your town has a business license requirement, you want to make sure you do that as well. So now this last one is kind of a hot topic in the accounting world. So, so I put on this slide that you need to do what's called your beneficial ownership interest filing. That is done at fincin.gov, depends on your size, but most small co-ops, as a small co-op, you want to just look at it, make sure you understand the requirements. It's not a tax, it's a filing. And the attempt is to make sure that we're not all laundering money. So you got to upload a picture of your license. I've done it, it's pretty straightforward. But last week, the Supreme Court came out, I think it was the Supreme Court, somebody came out, one of the higher tax courts came out. Courtney, do you have information on that?
I think
No.
it's the court out of Texas, but yes, some high Supreme Court,
So,
yeah.
So yeah, some high Supreme Court came out and said that is not enforceable, right now. So there's a big pause on it. Your accountant will be up to date. Again, not just co-op specific. This is a ruling that was specific, that was for all business owners, that you needed to really, if you have a bank account, you need to assess whether or not you need to make this filing. And so now it's kind of up in the air. So just be aware that that exists is my recommendation at this point. I'm always of the opinion that it's kind of easier to file and not get penalties than to not file. There's no penalty for filing when you don't have to, but it's really up to you. Some people don't want to upload a copy of their driver's license to the government. Your choice. So, just be aware so that you're making an informed decision, right? Is all I can say at this point, because who knows what's going to happen with this. Okay, next slide. Online resources. This is one of my favorite ones. There's lots and lots and lots of online resources for cooperatives. The big one for worker co-ops is a really great organization called the U.S. Federation of Worker Cooperatives. They have information in both Spanish and English, which can be very helpful. They are kind of the big, I think they're a co-op themselves, or maybe they're a nonprofit. They operate cooperatively, wealth of resources. You can get people on the phone there if you have questions. Just a really great organization all around. This issue of how your employee owners should treat a patronage distribution on their personal tax return is always an issue that comes up. And what I recommend to all my co-op clients is to say, we are not your tax accountant. Do not give them tax advice, but what you can give them is a resource, right? Because they're our employee owners. So we want to do right by them. So we give them a resource, and they can take that resource to their personal tax accountant, right? So you don't want to be I don't even give tax advice to individuals because I work on co-ops. So you want them to give it to their tax accountant, but this is a great resource for that. And so the issue there is that if it's treated incorrectly, they're going to have to pay self-employment tax on that. And we don't want that. Nobody wants to pay taxes they don't have to pay. So you want to make sure it's treated appropriately on your personal return so that you're not paying extra taxes on it. There's a great resource here called Co-op Law for worker owners. If you have some questions there. Start.coop has some great online courses for co-ops. They also have an incubator to really, but you have to get accepted into that, but it can really get you in front of some people who might invest in you. Project Equity is an amazing organization out of the West Coast. I think they're out of Washington. They're all about employee ownership in general, so not just co-ops, but there are a lot of really good resources on there. And if you're interested in converting a business to a co-op, they are also an excellent resource. Now, this last one is near and dear to my heart, and that is because even though I'm here in Georgia, I have 2 clients in Arizona, and that's because there are not enough accountants working specifically on cooperatives. And so the National Society for Accountants of Cooperatives is what that should say. The National Society for Accountants of Cooperatives is NSAC, like National Society of Accountants of Cooperatives, and then we are cute, we go co-op, NSACcoop.org. That is an organization that is for people who are accountants, obviously, for cooperatives, and it is a great resource. So if you have an accountant that you love to work with and they are never worked with a co-op before, or they just have some questions, refer them to this organization and they will be in good hands. They can find a lot of great resources. They can find a lot of people to network with. There are conferences and things like that. You are also always welcome to send your accountant my email address. I will be happy to talk to them about all the resources. We need more local accountants who know you and your business very well. We need more accountants working in the cooperative space. So I'm always very happy to share more co-op information out with accountants if you have one that you love working with.
Well, thank you so much for joining us today to learn about this very important topic. Don't forget to download the details of this presentation so that you can look at those resources later and refer to other information in here. Thrive Consultancy would like to thank Audrey Griffin for all of your wonderful help and expertise. Audrey, we couldn't have done this without you. Thank you so much. And we also want to thank the City of Phoenix Feel free, as Audrey said, to reach out to her if you have a CPA who has questions, or maybe if you just have questions. You can also reach out to Thrive. While I'm not a CPA, I do know much about bookkeeping and the accounting piece. So I could maybe help if you need questions or have questions on software or something. So definitely reach out if you need any help. And we hope to see you at another event soon. Thanks so much.